Cryptocurrency Dividend Investing. A full guide, cryptocurrency dividend investing is becoming a more and more popular way to make money passively in the world of digital assets. It gives you a good reason to choose something other than the usual buy and hold strategies by giving you a stream of income just for holding certain cryptocurrencies or tokens. But there are some problems and risks with it. This detailed roadmap will help you understand the ins and outs of investing in cryptocurrency dividends, which could help you make smart choices and possibly create a steady stream of income. What you need to know about cryptocurrency dividends. Cryptocurrency dividends can come from a variety of places, unlike traditional stock dividends, which come from a company's profits. The underlying mechanism and purpose of the cryptocurrency or token often determine these sources. For instance, proof of stake, POS, rewards. A lot of POS cryptocurrencies give staking rewards to token holders who help check transactions. These rewards aren't exactly dividends, but they work in the same way. You get paid for holding and staking the coins. Ethereum, ETH, Cardano, ADA, and Solana, SOL, are some examples. Transaction fee sharing. Some decentralized exchanges, DEXs, or platforms give token holders a share of the transaction fees they charge. The more people use the platform, the more dividends they get. Tokens that are linked to decentralized exchanges like PancakeSwap, Cake, and SushiSwap, Sushi, are some examples. Revenue sharing. Some projects make money by doing things like lending, borrowing, or offering other financial services. Then, they give some of this money to people who own tokens. Nexo is a well-known platform that has paid dividends based on its profits in the past. Staking derivatives. Some projects offer staking derivatives that pay holders rewards based on the staked assets that they own. This method makes tokens more useful and increases their liquidity. Lido Finance, LDO, is one example of a project that offers staking derivatives for Ethereum and other digital currencies. Rebase tokens. These are more complicated and sometimes controversial, but they change the number of tokens in circulation based on market conditions and give holders rewards, or rebases. These tokens can change a lot, so you should do a lot of research before you invest. Looking into cryptocurrencies that pay dividends. Before you start investing in cryptocurrency dividends, you need to do a lot of research. Think about these things. Project fundamentals. Look at the project's white paper, team, technology, and potential in the market. Is the project fixing a problem in the real world? Does it have a strong community and a clear plan for the future? Stay away from projects that make vague promises or are hard to understand. Dividend yield. Look at the dividend yield, which is the current token price divided by the annual dividend payment. It may seem like a good idea to get a higher yield, but you should look into how long the payout will last. If the yields are not sustainable, it could be a sign of a Ponzi scheme or a project that is giving out too much money. How often you get paid. Find out how often dividends are paid out, such as once a day, once a week, or once a month. More frequent payouts can help you make more money over time. Know where the dividends come from. Is it coming from a real and long-lasting source of income, like transaction fees or platform revenue? Stay away from projects that depend on methods that can't last, like giving out new tokens all the time to pay dividends. Market cap and liquidity. Think about the cryptocurrency's market cap and liquidity. A project that has a higher market capitalization and liquidity is usually more stable and well-known. Security audits. Make sure that well-known security firms have checked the project's smart contracts. Audits can help find possible weaknesses and lower the chance of hacks or exploits. Exchanges and wallets that let you get dividends. How to get cryptocurrency dividends can be different for each coin or token. Some wallets and exchanges have built-in support for dividend payments, which makes it easier to get and keep track of your money. For example, centralized exchanges, Binance, Kraken, and KuCoin have all supported dividend payments for some cryptocurrencies in the past. You should check with the exchange to find out which coins can get dividends. Some decentralized exchanges, DEXs, like PancakeSwap and SushiSwap, give rewards to token holders who stake their tokens on the platform. Staking wallets. Most POS cryptocurrencies have their own wallets that let you stake your coins and earn rewards directly from the blockchain. Daedalus for Cardano, ADA, and Phantom or Solflare for Solana, SOL, are two examples. Custodial lending platforms. In the past, platforms like Nexo, BlockFi, Historical, and Celsius, Historical, have paid interest or dividends on some crypto holdings. However, these platforms have come under regulatory scrutiny, and some have had financial problems. Be very careful when using custodial platforms and think about the risks before you do anything. Warnings and risks. There are a number of risks that investors should be aware of when it comes to cryptocurrency dividend investing. Price volatility. The prices of cryptocurrencies change a lot, and the value of your holdings can change a lot as well. Even if you get regular dividends, a big drop in the price of the token can wipe out your earnings. Project sustainability. The dividend payment depends on how well the project does and how long it lasts. If the project fails or has money problems, the payments of dividends may be cut back or stopped completely. Smart contract risks. A lot of DeFi projects use smart contracts, which can have bugs or security holes. Hackers can take advantage of these weaknesses, which can lead to the loss of money. Regulatory risks. The rules and laws that govern cryptocurrencies are always changing, and new ones could affect how dividends are paid out or whether some projects are even legal. Tax implications. Most of the time, cryptocurrency dividends are considered taxable income, so you may have to pay taxes on the money you make. Talk to a tax expert to find out what the tax laws are in your area. Tax effects. Depending on where you live, the tax treatment of cryptocurrency dividends may be different. Most of the time, cryptocurrency dividends are taxed like stock dividends. You might have to tell the IRS how much money you made and pay taxes at your normal income tax rate. To make sure you're following all the rules, it's important to talk to a qualified tax professional who knows the tax rules in your area. Doing your homework is important. Investing in cryptocurrency dividends can be a good way to make money without doing anything, but it's not a way to get rich quick. To be successful, you need to do a lot of research, plan carefully, and think about the long term. Before you put money into any cryptocurrency that pays dividends, make sure you know what the project is about, how it works, and what the risks are. You should only put money into things you can afford to lose, and you should always do your own research. DYOR. In conclusion, cryptocurrency dividend investing is an interesting way to make money passively in the fast-changing world of digital assets. You could make a steady income while helping to grow new blockchain projects by learning about the different types of cryptocurrencies that pay dividends, doing thorough research, and carefully weighing the risks. Keep in mind that success depends on doing your homework, managing your risks, and looking at things from a long-term point of view.